All right, welcome back, and this is the second video on the chapter dealing with capital structure. In the first video, I've dealt with the net income approach. Here, we are going to look at the net operating income approach, also propounded by David Duran. This approach is just the opposite of the net income approach, and here, according to NOI, the net operating income approach, the capital structure of a firm is irrelevant. It does not matter whether the debt equity ratio is 0%, 20%, 50%, 80%, or 100%. According to NI approach, it does not matter what the debt equity ratio is. The value of the firm will remain constant. So also will the cost of capital. The average cost of capital, KO, will also remain constant along with KD. But what will change is KE. So as the debt equity ratio increases, all right, as it increases, KD, KO remains the same, but what will increase is KE, the cost of equity. And according to the net operating income approach, the total value of the firm V remains constant irrespective of the debt equity ratio mix. All right, and so the market price of equity shares will therefore also not change on account of change in debt equity mix. Hence, there is nothing like optimum capital structure. Any capital structure will be optimum according to the NOI approach. Now, the critical premise of this approach is that the market capitalizes the firm as a whole at a discount rate which is independent of the firm's debt equity ratio. As a consequence, the division between debt and equity is irrelevant. All right, and here the this NOI approach, okay, employs the physical law, okay, that of the law of conservation of energy. That, for example, let me show you with this. That if you look at a circle, now I admit this is not a perfect circle, all right. Now, it says that it does not matter whether your debt equity ratio is 1:3 or 3:1. It does not matter, because at the end of the day, the law of conservation of value, kicks in. All right, so the value remains the same. So let's say if this circle is V, all right, whether the debt equity ratio is 1:3 or 3:1, it remains the same. All right, the value remains the same. Of course, that's a very silly example. I'm going to show you a real one, don't worry. All right, so according to an NOI approach, as the debt equity ratio increases, as the financial leverage increases, KD and KO remains constant, but the KE will increase. And this is because the market capitalizes the firm as a whole, and not and at the rate, the discount rate is independent of the firm's debt equity ratio. All right, now here you'll notice that KE, the cost of equity, increases. Now, why is that? Now, an increase in the use of debt funds, when you increase the debt in capital structure, which is a cheaper source of finance, now that is offset by an increase in equity capitalization rate, KE. Okay, now because you see, the equity shareholders, when you bring in more debt, the equity shareholders will not be happy with the current rate of return, the current expected rate of return, because as you bring in more debt, the interest payment goes up. All right, so the equity shareholders bears all the risk, and that is why when you bring in when you bring in more debt in the capital structure, KE will increase. Now again, like the previous problem, we are going to prove the NOI approach with the help of a numerical problem here. All right. Now, the following details for ABC Limited are given. Average cost of capital KO is 12%, cost of debt capital KD is 10%, net operating income EBIT is 15,000, total capital structure is 1 lakh. Calculate the cost of equity KE and the value of the firm V for each of the following alternative financial leverage under NOI approach. The leverage debt to capital total capital is 0%, 20%, 50% and 80%. So like again, I'm going to draw this small little graph here so that later on all right, this debt equity will later on we'll look at it again. KD, KO and KE, KE, KD and this is KO and this is KD. Always remember KD or KE is always greater. Always KE is always greater than KD. Always remember that. Okay. Now let's calculate let's find out the equity earnings. Okay. So this is the debt equity ratio. Here it is 0%. So D is 0%. Here D is 20. D is 50%. D here is 80%. All right. So what is the value of debt here? 0%. So 0 of the total capital structure, the total value, it is 0. So 0% is 0. Here 20%. So 20% of 1 lakh is 20,000. 50% of 1 lakh is 50,000. And 80% of 1 lakh is 80,000. All right. Now your net operating income, net operating. Oh wait, sorry. Let's rub that. Let's show the capital structure first. So here debt, debt is what? Debt here is 0. This is 20, 50, 80. And your equity capital is 1 lakh. This will be 80,000. This will be 50,000 and 20,000. Now, your net operating income. Net operating income, EBIT. What is EBIT? It is given as 15,000. Minus interest on debt, okay, at the rate of, what is KD? KD is given as 12%. So 12% on what? On the debt capital, okay. And so 12% of 0 is 0. 12% of 20,000 is what? 12% of 20,000 is 2,400. Is it? Yes. Wait, again, cost of debt capital. All right. No, I made a mistake. Cost of debt capital is not 12%, it is 10%. KD is 10%. So at 10%, sorry. All right, at 10%. So 10% of 20,000 is 2,000. 10% of 50,000 is 5,000, and 10% of 80,000 is 8,000. Now, just like net income approach here, the same assumptions will apply. There's no income tax, corporate or personal. So this is your equity earnings. This will be 15, 13, this will be 10,000 and 7,000. All right, now let us find out the value of the firm. Now V is equal to D plus E, but at the same time V is equal to how do you find out KD so KO is equal to EBIT by V, so therefore V is equal to EBIT by KO. V is equal to EBIT by KO. All right. Now, how you already know what is your EBIT. Your EBIT is 15,000. So 15,000 divided by the cost of capital KO, which is given 12%. Okay, divided by 0.12 is 1,25,000. Again, 15,000 divided by 0.12 is 1,25,000. So here V remains the same. Okay. Now, what is the value of debt? D. Here it is 0. This is 20,000, 50,000, and 80,000. Now, market value of equity, E is what? Now, E can be found out by deducting the market value of debt from the market value of the firm V. Now, we know what is V, we know what is D, so E is equal to V minus D, which in this case is 1,25,000. Sorry, here it is 1,05,000. This will be 75,000 and 45,000. So there we have found out the market value of equity. Next is we need to find out what is KE, and KE is nothing but equity earnings divided by market value of equity. All right, now equity earnings in the first case we found out is 15,000. So for 15,000 divided by the market value of equity, which is in this case is 1,25,000 into 100. So this is 12%. This will be 13,000 divided by 1,05,000. This will be 12.38%. Here 10,000 divided by 75,000. So this is 13.33%, and 7,000 divided by 45,000 will give you 15.56%. So you'll notice here that as the debt equity ratio increases from 0% to 20 to 50 to 80, you'll notice that KE also increases from 12% to 12.38, 13.33 and 15.56. Thereby we can, proving that, that according to the NOI approach, as the debt equity ratio increases from 0% to 20% to 50% to 80%, what will happen is KD will remain constant, KO will also remain constant, the value of the firm will also remain constant. You see that? V, it remains constant. Alright, but what will change is KE. KE will increase, and you see that as the debt equity ratio increases, KE also increases 12%, 12.38, 13.33, 15.56. Alright, thereby, proving that, according to the NOI approach, everything else remains constant. Alright, only KE will increase as the debt equity ratio increases. And according to NI approach, there is no such thing as an optimum capital structure. Alright, because the capital structure of a firm according to the NOI approach is irrelevant. Okay, stay tuned for the next couple of videos on capital structure.